So an RSU is it's like a share that you get. It's a stock option, so it stands for restricted stock unit. And effectively, what these are shares that don't have a lot of rights when you first get them, but those restrictions are lifted later date, so they become pretty much like a normal share. So they're like a share, and they're taxed in a similar way to a share. So when you first receive an RSU, you shouldn't have to do too much. Your employer should sort the taxes out for you. So effectively, most RSUs are liable to both income tax and national insurance. What your employer will do is account for that under the normal PAYE rules, and usually they will sell some of the shares that they have given you. So the tax comes when they vest, but when they vest, they will sell probably about half of the shares that you're entitled to at that point, and that will be used to cover the taxes. If they don't do that, you will need to report it under self-assessment, but 99% of employers do sell as they go along. They may also ask you though to pay your employer's national insurance at the same time, so it's worth checking to see whether they're doing that. The benefit is that it's still better than having cash in many ways, because you're hoping that the share price is going to go up over time. So at the point they work out what you're entitled to, they will work it out based on the value at that point. So that's when you get granted shares, you'll be granted them at a particular price. When they vest, they'll already be worth more than that, so you're already getting more usually than you would have been entitled to. At that point though, if you decide then to keep them, you've got this investment in your hands, and if the value keeps going up, you're going to pay capital gains tax on that, which is at a much lower rate than income tax. Because income tax, you might be paying up to 40%. Plus national insurance. If you're getting the growth at capital gains tax rates, you're only going to pay tax at 20%. So they're quite beneficial to have, so it's definitely worth it. If your employer is offering them to you and there's no alternative to not having them, definitely take them. So when you come to sell them, that's the interesting thing. It becomes more complicated because you are open to the capital gains tax regime at that point. Capital gains tax is relatively straightforward for most things because you take what you paid for the shares off of what you received for them, and the difference is what you're taxed on. And you'll be taxed on them usually at 10 or 20% depending on what rate taxpayer you are. The problem with RSUs is you will have lots of shares that have been acquired and vested over different times, and at every different time those prices, the price of the shares will be different. They'll also potentially, if you're getting them in dollars, and most RSUs are in dollars, you'll be paying them, receiving them at a different exchange rate. What we have to do is something called share pooling. So you have to try and work out an average price for your shares before you can work out what the value of what you've just sold is, which gets a little bit complicated because complicated records need to be kept, and that's something CBW can help out with. The other problem is that HMRC has some really funny rules. So it could be that you are treated as selling your shares before you've even received them if new shares vest within 30 days. So it's something you have to keep an eye on. It's quite good if that happens because it means your gain will be less, but it is more complicated to work out what the gain is going to be, which is why we have a system in place to allow you to project what tax you're likely to pay and what the gain is going to be, because it's not something you can just open and look. It's not obvious from the information you will have with you as to what the results are. Helpfully, on top of that, the Americans have a different way of working out what the tax is going to be and what the gain is going to be, and usually if you're using one of the brokers, it will be done the American way. So again, the information you've got will not necessarily be useful for UK tax purposes. So CW have been working with a number of the large tech companies over the last 3 to 4 years, so we've got quite a lot of experience in doing this now. We've developed a system where we can help out. What we tend to do is get involved with people early, so it's really important that you take the advice early because it's cheaper for you and it's easier for us. We put together a history of your shares so that you understand at any one point what your average price is, what your average values are, and what's involved in that. So we can do projections of what your tax might be if you wanted to sell some. We can work out how many you should sell if you wanted to pay no tax at all, so to save within your annual allowances. And we can also help with working out what the tax would be if you need to realise a certain sum of money. One of the other things we do is we work closely with our international network, the FK. And so if you've got any subsidiary issues, for example, American tax is being deducted from amounts you're receiving in dollars, we can work with them to make sure that you're signing the right form so you don't have to pay that. So basically we'll give an all-round system that will help you do that. We can also help you on a more general level to report your taxes, or we can provide you with one-sheeters that will allow you to do your own tax return to report these sort of gains. Again, working with the team we have here to get this all sorted.